So now let's start with the sources of finance. Actually, there are different sources of finance that are available for a company. So we'll have a look at the different things. Actually, the sources of finance is very important for a company. Without finance, a company cannot survive. When we want to classify the sources of finance, we can classify according to the time period, according to the ownership and control, according to the sources of generation, and even these are all the basic classifications of the sources of finance. So based on time period, based on ownership and control, and based on the source of generation, because these sources are used in different situations. See, if you want to use each source, we have to evaluate and then which source we have to be used for the particular situation. All these things can be analyzed by the finance manager of a company, and this source of finance is the most explorable area, especially for the entrepreneurs who want to start the new ventures. So the next thing is deciding which source of finance is very important for a company. It's like again a very challenging one. Deciding whether long-term source of finance or medium-term or the short-term source of finance is again a very challenging task for the finance manager. And one more thing, choosing the right source of mix is also very important as far as the finance manager of your company is concerned. So these are all the different classifications of the sources of finance. When we talk about the basis of time, we can classify this based on the long term, medium term, as well as the short term. Under long term, we can categorize that into equity share, preference share, internal accruals, debentures or bonds, term loans, venture funding, asset securitization, and even international financing like euro issue, foreign currency, loans, ADR, GDR. So these are all the different what we call it as the source of finance, long-term source of finance that we can classify based on the time. When we talk about the medium source of finance, we can classify that as a preference share, debentures, then medium-term loans from financial institutions, banks, then lease finance as well as hire purchase finance. In case of short-term finance, it's mostly used for working capital and mostly trade credit, then short-term loans like working capital loan, then fixed deposits which have a tenure of less than 1 year, then advances received from customers, then creditors, payables, factoring services, and bills discounting. So these are all the different short-term sources of finance that classified under the based of time. The next thing is classifying the source of finance based on the ownership and control. So if we can classify, we can divide this into two, like owned capital as well as borrowed capital. Under the owned capital, it comes under the category like equity capital, preferential capital, retained earnings, convertible debentures, venture funds, or private equity. Then, in case of borrowed fund, we categorize into loan from financial institutions or banks, then debentures. On the basis of source of generation, we can classify the source of finance as internal finance as well as external finance. Internal finance are nothing but internally generated funds. If the classifications comprises of equity capital, preference share, retained earnings, convertible debentures, then we can classify that venture fund or private equity. Under the external source, it can be classified as retained profit, reduction of working capital, then sale of what do you call it as assets. These are all like external source of finance that can be classified under the basis of source of generation. Then according to time period, as I said, according to time period, one of the classification is a long-term source of finance. So here, when a loan or when a source is available for a period of more than 5 years or 10 years or 15 years, then we can classify that under the category of long-term sources of finance. And these are mostly used in terms for purchasing plants, machineries, land and building, and for other long-term purposes. So a part of the working capital is also can be financed with the help of long-term source of finance. The working capital can be classified as permanent working capital as well as temporary working capital. Permanent working capital is a fixed one, so that can be financed with the help of long-term source of finance. So the next category is these are all the classifications which I have explained in the previous slides. The long-term source of finance can be obtained in any one of these forms. When we talk about the medium source of finance is nothing but the finance which is available for a period of 3 to 5 years. So those type of finance are nothing but the medium source of finance, and what for it is used is mostly like for being it's say for example when long term capital is not available, or if any other things which has to be fulfilled for a period of 3 to 5 years, then expenditures like advertisements, these are all the things. The medium source of finance is the major one the company follows, and these are all the medium term sources of finance, which I've explained in the first slide itself. Then, when we talk about the short-term source of finance, the short-term source of finance is nothing but the finance which is available for less than 1 year, and mainly it is used for what you call as fulfilling the working capital requirement. And these are all the different short-term sources of finance, starting from trade credit to bills discounting. Then, when we talk about according to ownership and control, so these are all the two categories. According to ownership and control, we can classify the source of finance as owned capital as well as borrowed capital. Under the owned capital, it's again equity. It's like a own source that the company can use. It's like mostly from the source from promoters of a company in case of the sole proprietorship company, or from the general public through IPO from what you call it as in terms of public limited companies. So the promoters start the business by bringing in the required money for a startup. It is a long-term capital, which means that it stays permanently with the business. Again, the owned capital is nothing but mostly in case of promoters. I mean, in case of sole proprietorship, it comes from promoters. In case of partnership, or sorry, what we call as the public limited companies, it comes from the general public. So since it's like a long-term source of finance, it stays with the company throughout the period till the company dissolves. So these are all the different owned capital or the sources of owned capital: equity, preference, retained earnings, convertible debentures, venture fund or private equity. And the meaning of venture fund and as well as the convertible debentures will be explained in the coming slide. The next one is borrowed capital. Borrowed capital is nothing but again a debt capital which comes from outsiders. So all the what you call as external source of finance. Here there is no dilution of ownership. See, in case of owned capital or in case of equity, the ownership will be diluted. For example, if there are some 10,000 shareholders in a company, this year the particular company can pay the dividend to the shareholders only for the available shareholders which are there in the company. So next year, if company issues additional equity shares, the ownership gets diluted and they need to pay more dividend to the shareholders. Whereas in case of borrowed capital, there is no ownership dilution. So the cost of borrowed fund is also low when compared to equity, because in equity, lot of flotation cost as well as paying to the underwriters, paying to registrars of the issue. So many funds, what you call as the cost is involved. Whereas in case of borrowed capital, it's not like that. They can easily get from the different sources like debentures, or they can go ahead with banks in the form of term loans. These are all the examples of borrowed capital. Next, if you see according to the sources of generation, we can divide what we called as the source of fund as internal sources as well as external sources. Internal sources are nothing but again which is internally available in the business, like in the form of retained profit, or when they reduce the working capital, that is also an internal source of finance, as well as sale of assets. These are all nothing but these are all the internal source of finance that is available for a company. And in case of external source of finance, what are the different things that are available is the external source of finance is the capital is generated outside the business. So outside the business, what are the things that can be generated? Those things will come under external source of finance. Then in case of equity share, if you want to see elaborately about equity share, so equity share is nothing but the other name of what we call as ordinary share or a common share. We call that as the owners of equity share, we call it as equity shareholders. They are the legal owners of a company. So why we call them as a legal owners of the company is the reason is they have the voting rights. They have the voting rights, and for example, each share is nothing but equal to one vote. For example, a particular shareholder is having 1,000 shares, which means that the particular shareholder is having 1,000 vote. So during the board meeting or any important decisions, the particular shareholder can is eligible for voting. So he can decide who's going to be the what do you call as the high net worth shareholders. We call them. They decide who is going to be the board of management, who have to be appointed as the particular MD or chairman of a company. All these things can be decided. That's why they call them as legal owners of the company. And one more thing is like see here even the owners becomes what you call it as the shareholder of a company. So by this way the problem of agency problem and agency cost can be solved. So the next thing is like as I said, like it's again we call that this as variable income security. Why we call this as a variable income security is at the time of issuing, the company may not know, or even the shareholders may not know how much dividend the particular shareholder is going to receive at the end of the year. So because see, it's like the percentage of dividend in case of equity shareholder or shareholding will be decided based on the net profit what the company receives at the end of the year. So that is why we call this as a variable income security. And in case of features, what are the features the particular equity share or ordinary share has is it has a claim on income, claim on assets. And one more thing, this equity share or equity shareholder will be called as a bonus of the residue. What this means is like when company dissolves, so first the company will settle down the creditors of the company. The creditors of the company normally whom we call as the loan given by the banks as well as the debenture holders. So first it will be settled down. Next they will look after the preference shareholders, and finally what is left over alone will be given to equity shareholders. So that is why equity shareholders are called as the onus of residue. Whatever leftover that is available, that alone the equity shareholders will receive at the time of dissolving the company. So the next thing is they have the right to control, they have the voting rights, and they have the limited liability. These are some of the features. And what are the advantages? This particular what do you call it as equity share as is it's a permanent source of fund for the company. So it's a permanent source. Once if someone invests in the IPO in the form of equity share, so again, what company will do is, see, once even the particular shareholder sells and go back, others will buy that. Okay, so it's like it's a permanent source of fund for the company till the company buybacks the share in the form of share buyback. The next thing is increase in the borrowing capacity. For example, the equity share increases the company shareholders funds. So lenders normally lend in proportion to the amount of shareholders fund. Higher amount of shareholders fund provides higher safety to the lenders. So when, for example, when the equity capital is more, then which means automatically the borrowing capacity of the particular company also increases, because the loans given by the company will be based on how much equity the particular company has. Then next is it's not bound to pay dividend. The company is not legally bound to pay dividend to the equity shareholders, because it's not like a compulsory for the companies to pay dividend, but the company should definitely pay in the sense like to satisfy the shareholders, because it's like the everything is based on the what do you call it, shareholders fund. The company most all the public limited company run the company based on what do you call it as equity shareholders fund. So it's like even though it is not legal, all the public limited companies they pay dividend to the shareholders depending upon the level of profit what they achieve. Then next is no need to mortgage any assets. That is again another advantage we call it as. Why no need to mortgage any assets in the sense like for example, if they have an option of getting fund from public in the form of equity share, then no need to mortgage any assets with the bank to get further funds for development and other things. And in case of what do you call it as other what do you call it as advantages in terms of investors point of view, we call what are the advantages is dividend. Dividend is one advantage for the investors. The next advantage is bonus shares. So this bonus share will have a separate discussion in the coming chapters, but now let me explain about what is the meaning of bonus share. So every company what they do is they provide what you call as equity shareholders an additional share. For example, if company is supposed to pay a certain amount of dividend to the shareholder, but instead of if there is any insufficient fund in the company, they can give additional shares to the what you call as the shareholders. For example, for each share of a particular company will receive two additional shares, or each two shares of a company will be receiving one additional share as a bonus share. So which means a person who is having a two share in a company, just for an example, two share in a company, if the bonus issue is announced as for each two share, what do you call it as one additional bonus share, the next year this particular shareholder will be having three equity shares. So this year he will be getting dividend for two shares. Next year he will be getting dividend for three shares. So this is again another advantage in case of investors' point of view. Then next one is it's easy to sell as far as investors' point of view. They can apply either they can uh, what do you call it as get this equity share from IPO or from the secondary market. They can get this, and if they have any demat account with any stockbroker, they can easily buy the share. And the same way, it is easy to sell also. Just by clicking at what amount we need to bid, we can bid, and then we can what you call as a sell. Okay, we can ask and we can sell the particular quantity depending upon the market rate which is available on the particular date. And next, what will be the disadvantage of this equity share is this equity share is the cost involved is huge. Okay, why? Because if they want to issue the equity share, they need to get a lot of approvals from SEBI. At the same time, they need to appoint registrars of a company, underwriters. So the floating cost is very high as far as the equity share is concerned. That's why the cost of equity also will become very high. Then next is what are the other disadvantages from investors' point of view is irregular dividend, we may say. So this year, so as I told already, it is not legal for legal binding for any company to pay dividend to the shareholders, but every shareholders expects dividend from the company. So sometimes due to the further investment in the company may want to retain the entire fund. So that time the company can skip the dividend for the particular year or 2 years, 2 consecutive years also. So sometimes during that case, there will be irregularity in the dividend payment that may dissatisfy the shareholders. And the next thing is ownership dilution. If more and more, the equity shareholders are added in the company, the ownership in the company gets diluted. So these are all some of the disadvantages of equity share as far as investors' point of view is concerned. And this is about the preference share. So preference share capital is another source of long-term source of finance for a company. These shares carry preferential rights over equity shares, both in terms of payment of dividend as well as return on capital. So what this means is, as I told already, when company wants to pay dividend to the shareholders, the first preference will be given to preference shares. Then only the equity shareholders dividend will be paid by the company. So this is one thing. The next thing is also when company is dissolved. So during that time also company first settle down preference shares, then they at last only they'll come for the equity shareholders. And here again another advantage in the preference dividend is the dividend rate is fixed. In case of equity share, we may not know at what percentage of dividend we are going to get at the end of the year. We may not know because the company will decide at the end of the year. Whereas in case of what we call as preference share, the dividend rate is announced at the time of investment itself. So investors may know how much dividend they are going to get at the end. At the end of the year, they may know at the beginning of the year itself or at the time of investment itself. So that is again another advantage of preference share. That is why it carries a fixed rate of dividend, and it may be paid before the equity shareholders, as I told already. And what are the characteristics of this preference share is it does not allow preference shareholders to act as a real owners in the company. So these are all some of the characteristics. What that means is as I told, they are not the legal owners or the real owners of the company. Only the equity shareholders are the real owners, whereas preference shareholders are mostly the name itself, it is that preference. So the companies, they allot this preference share to other companies mostly. So these are all the one very what do you call as one of the important characteristics of preference share, and they make preference share payment to the preference shares possible during the existence of the organization, and it allows preference shareholders to receive dividend out of the profit earned by the organization. These are all some of the characteristics. As I told, the preference is given. The name itself, as I said, it's a preference. Preference will be given to preference shareholders, and they get what you call it as whatever income the company receives from that alone, they pay preference dividend to the shareholders, and they do not bind any organization to offer an asset as security to preference shareholders. So, for example, in case of equity share, if company not able to provide any what you called as a dividend for a particular year, then the company can give other forms of dividend also, like they can go for bonus share, or they can go for scrip dividend, or they can go for property dividend, all those things. But those things are not possible in case of preference share, and it carries less risk also when compared to equity share. The reason I said is like uh, in equity share, it's like a variable income security. This year you may get 100% dividend also, but next year you may get 0% dividend also, depending upon the company's requirement. Whereas in case of preference share, it is not like that. Since it is a fixed dividend rate, so that particular dividend will be given to the shareholders on that particular what do you call as a year. Then the next thing is, or what you call as a fiscal year. So the next thing is, what are the different types of preference shares that are available? One is called as a cumulative preference share. The next one is non-cumulative preference share. The next one is convertible preference shares and non-convertible preference shares, redeemable preference shares, as well as irredeemable preference shares. What is this cumulative preference share is nothing but it refers to the shares for which dividends gets accumulated over a period of time. So in the name itself is that cumulative, which means every year's dividend will be accumulated and finally it will be paid. Non-cumulative dividend share, in the name itself it is there. So it refers to the shares for which the dividends are not accumulated over a period of time, and organization has to pay the dividend on these share at the end of the financial year. So the definition is clearly given, cumulative as well as non-cumulative. By the terminology itself, we will understand what is the meaning of cumulative as well as non-cumulative. The next one is convertible as well as non-convertible debentures, or what do you call it? Sorry, preference shares. What is convertible preference share is, it refers to the shares which can be converted into equity share after a certain period of time. The holders of convertible preference share have to pay conversion price at a given date for converting their equity shares into preference shares into equity shares. So in the name itself, it is there. It is convertible preference share, which means they purchase at the time of purchase. They purchase as a preference share, but after some period of time, they can convert this into equity share. Okay, so this is again another what do you call as advantage of this cumulative, or so what do you call as convertible preference shares. They purchase as a preference share, but they can convert after some period of time as a equity share. For that, they need to pay some conversion price. Whereas non-convertible preference share, as I said, if they purchase as a preference share, they need to continue as a preference share alone. No need to, or what you can say is they cannot convert that as a equity share. The next one is redeemable as well as irredeemable preference share. So in the name it says the redeemable preference shares are nothing but it's repaid by the organizations. These preference shares are issued for a fixed time period and are paid during existence of the organization. What that means is see this redeemable preference share is for example, this preference shares are allotted, for example, they for a duration of 3 years or 5 years or 7 years like that. During this period, the investors will be receiving preference dividend, and after the period of the tenure is over, it will be redeemed by the organization. Whereas in case of irredeemable preference share, it is not like that. So once issued throughout their lifetime, they will be receiving the preference share dividend. It cannot be redeemed. It cannot be redeemed by the company. So these are all what you call as the different classifications as well as the types and characteristics of preference share. So next we'll talk about the debenture. So what is this? The debenture is a debenture is a long-term promissory note for raising loan capital. So then what is the advantage or the difference between equity share, preference share and debenture is when we purchase equity share of a company as an investor, if we purchase equity share of a company, you will be getting a variable dividend. Okay, this year you may get what you call as a 10% dividend, or next year 20% or even 100%, even 1000% dividend also we may be getting, or 0% also. Okay, so that is the dividend. The return what we get is a dividend and it is variable. Okay, that is not constant one. Whereas in case of preference share, like the shareholders may be receiving fixed dividend rate. So they may be receiving fixed dividend rate. The return what they get is fixed dividend rate. In case of debenture, as it's been mentioned, it's a long-term promissory note for raising long-term capital. So the companies they fix what you call as the price for each and every debenture. The debenture price may ranges from 10 rupees or 100 or 1000 or 10,000 or even 1 lakh. So the debenture price will be, and the interest is fixed here. The interest is fixed. The investors, we call them as debenture holders. The holders of debentures, we call them as debenture holders, and it is otherwise called as a bond. Normally, the difference is like when government company issues, we call that as a bond, and a private company issues, we call that as a debenture. So now, when public sector company issues, that's why it's been mentioned here, like a bond and a private company issues, it's called a debenture. And what are the features of debenture is long-term fixed income financial security. So the companies they may issue this for 1 year period or 5 year or 10 years period, and every year the fixed interest rate will be given by the company to the debenture holders, and they are the creditors of the company. Okay, it's not like equity share. They are the in equity share they are the owners, whereas debenture holders are called the creditors of a company. So that is why even if we take the balance sheet of a company under the long term liability, the two categories will be there, equity as well as a debt. Under equity share capital will be there, preference share capital will be there, as well as the reserves and surplus, the company's own retained earnings. These three things contributes the equity of a particular company. In case of debt, what are the categories that comes under debt is debentures as well as bank loan. So these two are the creditors of a company, and those things will come under the long term liability under the debt category. These two will come. Then the redemption. So what is the meaning of redemption is again when a particular company issues a debenture, the investors they may purchase, and it may have a tenure of some 3 years or 4 years or 5 years like that. After the period, the company can redeem that. Till that period, interest will be paid to the debenture holders. So that is again another what you call it as advantage of the debentures. And that's why it's a buyback provision is available. It's in the sense like it can be redeemed by the company, and the claim on assets and income. So as I told, the meaning is like then company dissolves at the time. The first thing they'll settle down the debt. Okay, which means the bank loan as well as the debentures. So they have a claim on income, which in priority to what you call as preference shareholders as well as the equity shareholders of a particular company. Then again, it can be classified as convertible debentures as well as non-convertible debentures. So convertible debentures, in the name itself, is similar to the convertible preference share which we have seen previously. So it's like they can convert that into equity share after some period of time. They can purchase as a debenture, but after some period of time, they can convert that into equity shares. Similarly, in case of non-convertible, it cannot be converted as a equity share after some period of time. And again, the redeemable, irredeemable preference share. The same meaning what we saw in case of redeemable preference share, irredeemable preference share, same thing. Okay, so redeemable debenture means it can be redeemed by the company after the tenure. They can what do you call as if 1 lakh is invested by the company, then the 1 lakh will be returned to the investors. And for example, let's take a simple example. For example, one debenture of a company is 1,000 rupees. So an investor wants to buy some 10 debentures of a company. So one debenture is 1,000 rupees, and 10 debenture a particular investor wants to buy. So 1,000 into 10 equal to 10,000 rupees. So 10,000 rupees is invested by the investor, and in turn he will be receiving some 10 debentures of a particular company. So this is assume that this is a redeemable debenture. So which means the tenure of the particular debenture is some 5 years. So for 5 years period, for this 10 debentures, the investor will be receiving the interest. After the tenure is over, for example, after 5 years is over, then this 10,000 will be returned by the company, and whatever the debenture certificate the company issued will be received back by the company. So this is redeemable. Whereas in case of irredeemable, that's it. Once the money is invested, it will be with the company, and the investor will be, or the debenture holder will be receiving the interest throughout their lifetime. But mostly investors as well as the companies also prefers redeemable debentures than irredeemable debentures. And what are the advantages of debentures is, like, it's, as I said, like, unlike shares, the cost involved is very less, and it helps in raising fund from investors who are less likely to take risk. And it provides fixed return to the debenture holders. So again, other advantage and as well as characteristics of what you call it as the debentures. And the next thing is, what are the disadvantages? Major disadvantages of this debenture is concerned is, it compel an organization to pay interest even there is no profit or loss. So that is again a very what you call it as the disadvantage as far as company is concerned. Even if company is in loss, they need to pay interest to the debenture holders. So that is as per the class it has been given like that. Then make it difficult for an organization to provide security against debentures if an organization has insufficient fixed asset, and it do not allow debenture holders to vote in the official meetings of an organization. That is again another disadvantage they say. Like why? Because the like preference shareholders as well as debenture holders, they don't have voting rights. So that is why that's been considered as the disadvantage of the debenture is concerned. The next thing is these are all the things which I have explained just now. Non-convertible debentures, fully convertible and partly convertible. In the sense, like non-convertible, I have explained already, which means we cannot convert that into equity share. And fully convertible debenture is like we can convert that convertible debentures. Okay, so suppose 10 debentures you are buying means all the 10 debentures you can convert as a equity share after some period of time. Partly convertible debenture is nothing but suppose 10 debentures an investor buys, then which means part of that can be converted as a equity share, remaining they can have as a debenture. Okay, so this is again what you call as uh, the the types of debentures the company issues normally. And what is this retained earnings is, a new company can raise finance only from external source of finance such as shares, debentures, loans, etc. Okay, for example, if there is a newly started company or startup, then they have no other choice. They have to go for external source of finance alone. They have to issue shares or issue debentures, or they can go for loans or the company's own fund, the promoter's own fund. These are all the only source because they don't have the last year profit or saved profit in the form of retained earnings is not available. So, for example, if it's a well-developed company, from the net profit, a part can be paid as a dividend, and the remaining part they can retain for future use. So that retained profit is nothing but the retained earnings, or otherwise we call it as a reserves and surplus. The company can use it for what you call it as the further expansion or whatever the future requirements for a company. We call this as a plowing back of profit, which means that they are plowing back the profit in the company itself for its own use. So that is the retained earnings. And what are the advantages? It's a very economical method, as it's said, like no flotation cost, no interest payment, no dividend payment, nothing. Like whatever their company owns, the same money they are plowing back in the company itself for their growth. And so that's why it's called the economical method, and a cushion to absorb the shocks in the business. For example, when reserves and surplus is very high, then we can say that like the company, even when there is what do you call it, some shocks. So like what happened during 2019, due to COVID, many companies suffered. So those of company who had reserves, sufficient reserves, they easily moved out of the circumstances. So it not only for companies, even for the individuals, when we have sufficient savings, we can move away with any shocks or, what do you call it as the uncertain situations that we face in our life. The same things. The company also, if they have sufficient fund, they can. It's like a cushion for during the shock of the business, and it helps in following a balanced dividend policy. When company follows a balanced dividend policy, so what that means is only the 50 percentage will be given as a dividend, means automatically the remaining 50 the company will save for the future, what do you call it, the future requirements of a company in the form of retained earnings. Then next thing is it helps in making companies self dependent. So because of the more and more accumulated reserves, it makes the company as a more self dependent one. So it increases the credit worthiness of a company. And reserves and surplus is more of a company, then automatically the particular company is credit worthy. Even if they require any external source of fund for in the form of bank loan or something like that, by showing the reserve, they can easily get that what do you call it as a credit, whatever. Next, we'll see about the disadvantages or dangers of excessive plowing back. When most of the money is plowed back to the company in the form of retained earnings, then there is a misuse of retained earnings. So, for example, the particular year, the company wants to plow back around 70% of the earnings. That is, they want to retain around 70% of the earnings. We may not know what for it has been retained, whether it has been retained for companies' use or for other unprofitable areas. Because the management will decide they may want to invest the fund which is obtained from a particular business to other business also, or for some other unproductive way. So in that case, it's been a misuse of retained earnings. The next one is overcapitalization. Retained earnings are used for the issue of bonus shares, which may result in overcapitalization without any corresponding increase in the income. So what we can say is if the plowing back of a fund is used by the company for the same company's expansion, so then it may benefit the shareholders as well as the investors in future. But if it is used for issuing the bonus shares, then which means the additional shares will give what do you call it, the ownership dilution, and it may lead to over capitalization in the company. And the creation of monopolies is again another what do you call as a disadvantage or drawback of more and more of plowing back of profits or retained earnings. So more, if a company accumulates more and more of money in the form of what do you call it as the retained earnings, then it may create a huge amount of wealth which is accumulated, will create monopoly in the monopoly among the similar type of companies. Then manipulation in the value of the share. Okay, plowing back of profit provides the management an opportunity to manipulate the market value of the share. So, in the name of plowing back of profits, they may declare lower dividend, and when the share value fall in the market, they just purchase and then purchase the particular share price at the reduced price, and again they may increase the rate of dividend, and and at the time they may sell the share and earn the profit. So so this is what happens in some of the companies in the real time. like um, when the company at the time of dividend announcement, they announce less dividend, and what happens is when many wants to sell the share because of the low dividend, the company may purchase that particular the share from the shareholder. Then what happens when the market, the share price falls in the market because of the low dividend payment as well as the highest what was a plowing back or retained earnings, So now the share price is dropped. Okay, so which means that the company purchases at the lowest price, and after some period of time they may announce a higher dividend. That may during that time the share price may increase, and the company, what they'll do is they'll just reap the benefits of the capital gain. So this happens in real time, the manipulation of the share price of a company because of excessive plowing back, so which means artificially they are reducing the share price, and after some period of time, because of higher dividend, the share price increases, the company will reap the benefit. So this is again another drawback of excessive plowing back. Then next one is dissatisfaction among the shareholders. So the shareholders are like, if company continuously reduces the dividend and increases the retained earnings, they'll be dissatisfied, and it's hindrance in the free flow of capital. Okay, again, so when the company saves or retains more and more of fund, whenever the fund is required in the free flow by the investors for the what you call as individuals in the form of a dividend, that is hindered because of what you call as the excessive plowing back. Next, we'll see about the loans from financial institutions. Again, it's again a very important source of finance. So, financial institutions often use this long-term source of finance, and they may receive either from the national level institutes like IDBI, Industrial Development Bank of India, or IFCI, Industrial Finance Corporation of India, or ICICI, Industrial Credit and Investment Corporation of India, or IRCI, or UTA, United Trust of India, or LIC, or GIC, General Insurance Corporations. So these are all like the well-established financial institutions from which the companies get what you call as loans, or they can go for state level institutes also, like state finance corporations, state industrial development corporations, and the next one, Haryana State Industrial Development Corporation, HSIDCA. All these things are state level corporations. From them also the companies what do you call as go for getting the loans. And what are the advantages of this loan from financial institutions? Maturity period. So it is available for a period of 6 to 10 years. So like it's like again a long term finance the companies go for, and during the tenure the interest alone will be paid by the company, and till that 6 years to 10 years duration. And it's again a direct negotiation between what you call it as the financial institutions as well as the companies, and security is the and restrictive covenants. So because once if a company gets a loan from a particular bank, then the particular bank will impose certain restrictive covenants. So without the bank's permission, they may not pay salary to the employees, or even they may not pay dividend to the shareholders, or even they cannot go for additional loans, and they have to maintain a sufficient current ratio, and they have to reduce the debt equity ratios. So these are all certain characteristics of loan covenants. So because of this also the agency problem comes, because of the restrictive covenants. Agency problems, like agency is like it's like the agent is like it's between the shareholders, creditors, then managers. These are all like agents of a company. So if any problem that happens between these agents are called as agency problem, and this restrictive covenant will be one of the what do you call as the important problem that arises between creditors as well as the shareholders, because of the restrictive covenant the company may not pay dividend to the shareholders. Okay, so which makes that there will be a problem between the shareholder as well as the creditor. So that will be solved when this restrictive covenants or see like ombudsman will solve those type of agency problem. So because of that, agency cost of the company also will increase. Then so the financial institution may also, so that's as I said, like they may also restrict the dividend salaries and other things, and convertibility is again another the characteristics of financial institutions. So many banks, what they do is like they give huge amount of money in the form of a loan, but if the particular company not able to repay, they want to convert that loan as a equity share. So they get the ownership in the form of what you call it as converting their loan into equity. And repayment schedule, such all the financial institutions loans have to be repaid according to the predetermined schedule. So like every month, what is the interest payment, then what do you call it as the payment schedule, detailed payment schedule with the outstanding loan will be given by the financial institutions to the particular the what do you call it as the financial institutions, from financial institutions to what do you call it as the companies whom they are getting the loan. So the next source of finance is the lease financing. So like as the definition says, a lease is defined as a contract between a lessor and lessee for the hire of a specific asset for a specific period on payment of specified rentals. So if it is a lease contract, a lessor will be there as well as a lessee will be there. A lessor is the legal owner of the asset or the property, and lessee is the party who gets the right to use an asset for a specific period and makes periodic payments to the lessor based on their initial agreement. So an agreement will be signed between a lessor and lessee for the use of a particular asset. So the lessor will be receiving the lease rentals from the lessee during the particular tenure. So this is about the lease financing. So the next thing is like what are the different types of lease that are available. So like we have financial lease, operating lease, leveraged and non-leveraged leases, conveyance type lease, then sale and lease back, full and non-payout lease, specialized service lease, net and non-net lease, sales aid lease, cross-border lease, tax-oriented lease, import lease, as well as international lease. So these are all the different type of lease agreements that are available. So even in that, the first three is more popular when compared to the other. So first, let us check what is the financial lease. So this financial leasing is a contract involving payment over a longer period. So it's a long-term lease, and the lessee will be paying much more than the cost of the property or equipment to the lessor in the form of lease charges. In this type of leasing, the lessee has to bear all the costs and the lessor does not enter any services. For example, a financial lease is generally treated like a loan. Here, asset ownership is considered by the lessee so that the asset appears on the balance sheet. So, for example, it's for the long-term period of the period of duration will be long-term as far as financial lease is concerned. Here, everything is like the lessee. The lessee will be paying the amount. For example, if the asset value is even 1 lakh rupee, the lessee will be paying more rental than the original cost of the particular fund. And see here, in this type of leasing, the lessee bear all the cost, and the lessor does not render any service regarding this. So it's more like a loan. It will be treated more like a loan. So the next is about operating lease. So in an operating lease, the lessee uses the asset for a specific period. The lessor bears the risk of obsolescence and incidental risk. There is an option to either party to terminate the lease after giving notice. So here the lessor plays a major role, and lessor bears all the risk and obsolescence. Here the lessee uses the asset for a specific period alone. So in this type of leasing, the lessor bears all the expenses, and lessor will not be able to realize the full cost of the asset, and specialized services are provided by the lessor. So this is about operating lease, and this kind of lease is preferred when the equipment is likely to suffer obsolescence. So, for example, in case of, for example, an operating lease is generally treated like renting. So here the lease payments are treated as operating expenses of the asset and not shown in the balance sheet of the particular company. So this is about operating lease. Here the lessor owns everything and lessor bears the risk, and he pays all the expenses and other things. So now we'll see about venture capital financing. It is the money provided to an outside investor to finance a new, growing, or troubled business. So if it's a startup, the most of the finance is through venture capital. So the venture capitalist provides the funding, knowing that there is a significant risk associated with the company's future profits and cash flows. Capital is invested in exchange for an equity stock in the particular business rather than giving a loan. So it's like more or less, for example, if it's a startup, the fund which the company gets is in the form of a venture capital. So the venture capitalist, or we can say as the fund providers, they know the risk involved in the business because see, it's a newly starting company and the cash flows and future profits are not known. And so the capital involved is sort of a huge risk. So instead of giving it as a loan, they participate in the equity stock of a particular company, and they become what you call as they play a major role in the development of the particular business in case of venture capital. And what are the features of venture capital investments? Is high risk, lack of liquidity, long-term horizon, equity participation and capital gains. Venture capital investments are made in innovative projects. Suppliers of venture capital participate in the management of the company. So whatever the decisions made in the company, so they become a part of the management, venture capitalist, and whatever decision that is taken by the company, and venture capitalist also plays a major role in that decision. And it's like, as I mentioned, like it's like high risk is involved. It's for the long period of time. So because since it's mostly used for startup companies or the new ventures, so the development of the company takes certain amount of time, and so that's why it's been of a long term horizon. And then so the types of venture capital funding. So actually, like the seed money, startup, first round of financing, second round, third round, as well as fourth round of financing is there. Seed money, it's like a low level financing for providing and fructifying a new idea. So when a company has a new idea, a seed money is given for as a low level finance to further development of the particular idea. Then startup. So new firms needing funds for expenses related with marketing and product development will be given startup financing. First round of financing is for manufacturing and yearly sales funding. Second round is for operational capital given for early stage companies which are selling products but not returning a profit. So that is second round of financing. Third round of financing, also called as mezzanine financing. This is the money for expanding a newly beneficial company. Fourth round of financing, also called as bridge financing. Fourth round of financing is proposed for financing the going public. So these are all the types of venture capital funding. And what are the advantages of this venture capital funding is like they bring wealth and expertise to the company. And as well as a large sum of equity finance can be provided with the help of this venture capital. And the business does not stand the obligation to repay the money. So because the venture capitalist, they form as a part of a management and they get the equity. So it's not like no obligation to repay because they become the part of equity. The next thing is, in addition to capital, they provide valuable information, resources, technical assistance to make the business successful. So these are all certain advantages of venture capital. And in terms of disadvantages, as the investor becomes part owners, the autonomy and control of the founder is lost. So this is again the very important disadvantage as far as venture capital is concerned. So the venture capitalist involved in all the decisions made by the company, and because of that, the what you call it as the ownership as well as the control is lost as far as the venture capitalist is concerned. So it is a lengthy and complex process. So it starts from idea generation to exit. So in each and every stage, a certain amount of duration is involved. So it's a long and lengthy period and as well as a complex process. And it is uncertain form of financing. So it's like we cannot, the company with a good idea cannot depend on venture capital alone because whether the venture capital will be providing the loan or not, there is no certainty. So like they have to apply for that. The company which is having a new idea have to apply for that, and after going through a lot of process, then the final judgment will be given by the venture capital companies, and that's why it is said like it's an uncertain form of financing, and benefit from such financing can be realized in long run only. So like immediate benefit cannot be reaped by the startup companies. It can be reaped in the long duration of time. Like it takes some minimum of 5 years to 10 years time to reap the benefits of venture capital. So these are all the different venture capital financing advantages as well as the disadvantages. And mostly this early stage of financing is used for seed financing, startup financing, then first stage financing. So these are all like the different early stages financing as far as this venture capital is concerned. And as far as expansion financing is concerned, like this expansion financing is mostly in case of second stage financing as well as bridge financing. So that is about what we call as the expansion financing, that we call as a mezzanine financing also. And acquisition or buyout financing is also there. Acquisition or buyout financing is categorized into acquisition finance and management or leveraged buyout. We call it as so leveraged buyout financing. So acquisition financing assists a company to acquire certain parts of the entire company. So the management or what we can say as the leveraged buyout financing helps a particular management group to obtain a particular product of other company. So it's like what we call as the acquisition or buyout financing. So that is one company, if they want to buy part of other company, or if they want to buy out other company or other companies products, then they can go for acquisition or buyout financing. So these are all the different the sources of finance what we have seen as far as what do you call it as the long term as well as the medium term as well as the short term source of finance is concerned. So in long term we saw about what do you call it as the equity share, then preference share as well as debentures. Then we saw about lease financing, then venture capital financing as well as the loans from financial institutions. So these are all the different types of the long term, medium term as well as the short term source of finance. And here, the next, the coming chapter, we'll be discussing more about the individual, what you call it as the source of finance, as well as how it's going to be helpful for the companies in a long term.